Okay, good evening, everybody. Let's go ahead and get started. Let me know if you guys can hear my audio and see my screen in the chat box. Just give me a little Y or yes there. It's just to let me know that it is indeed working. Hope everybody's had a fantastic evening so far. It was awesome to see many of you in the sentiment webinar that we just had a few moments ago. Good webinar. That is now recorded and uploaded, so should be rendered here in the next couple of minutes to view if you want to watch it again. And for those of you that missed it, you can watch it later. So, well, awesome. Also want to give a shout out to those in the recording. Want to say hello to you guys and welcome you here. And feel free to participate in any way that you can. If you guys have questions throughout the webinar, feel free to ask those questions as we go about our discussion today. As always, I need to remind everybody about the risks involved in this market. You can lose all or more than your initial investment if you're not careful. So please be aware of how many pips you're risking on each trade, in addition to how big your lot size is and ultimately how that would affect your account if you lose money. So make sure that you're going through that process each and every time that you take a trade. All right, guys, let's go ahead and get started. Let's see. Roger says, by the way, coach, thank you for the Bitcoin video. Oh, I'm super happy that you enjoyed that. Yeah, maybe we'll discuss a little bit more of that live. I recorded that on my own, so I didn't have really an audience, but I'd be more than happy to discuss details of that if that's something you guys want to talk about later. So here's what I'd like to do today, guys. I'd like to accomplish these things, and then, of course, we can leave it up to you if you have other questions or other things you would like to talk about. But what I'd like to do today is obviously cover the just real basic. I can see most of you have been here before, so we'll do just the basic COT report, understanding of the COT report. Unless you guys have other more detailed questions, we can do that. Then I want to talk about the integrations that we've made into the scanner from the COT report data and how we use that information to provide these signals for the week. And then lastly, just talk about our plans going forward. Then after that, we can leave it open for more of a general discussion. If you guys want to talk about, I remember I said I would share one of my risk management techniques that I've been using with some of my swing trades, which I think you guys really might enjoy. And then we can talk about, the crypto prediction for next year, if that's something you guys want to talk about. So, all right, guys. Well, let's go ahead and let's do this. So we already went over the disclaimer. So let's talk about the CFTC COT report. So this is basically so much of what we do with Trading with Steve. So the CFTC stands for Commodities Futures Trading Commission, and they monitor and regulate the commodities and futures market in the United States. And one of their responsibilities is to release what's called the COT report, which is known as Commitment of Traders Report. And they release it to us so that just the general public can have information as to what people are buying in the market. And this is usually made and used in the futures world of things, right? So Forex trading is actually not it's not a market that is controlled or centralized. It's a decentralized market. So when we oversee, like in the United States, when we oversee brokerages that trade Forex and provide Forex trading for their clients, it's there's an oversight that is provided by the CFTC and the SEC over brokerages like Owanda, Forex.com, and so on. TD Ameritrade also trades Forex contracts. But it's not something that's monitored on an actual legacy report or an exchange. So just something to be aware of. The Forex market, since it's traded globally on a decentralized network, every broker kind of in a way is its own market for Forex. So that's why I feel like one of the big hot topics in Forex trading is what broker to use. And I think one of the reasons why it's such a big topic is because every broker kind of makes up what the market looks like. Now it follows very closely, but it is something to be aware of. Okay, so when we look at the COT data, we come over here. If you go to market data and economic analysis, you come to commitment of traders. This is where the COT reports are. You can look at historical COT reports over here on the left side. These are all current COT reports. So you've got COT reports for agriculture, metals, electricity, gas. You've got the financials futures report right here. You've got the legacy reports. This one is the most common. It's the CME COT report. on and we use the short format. This is what it looks like every week. So when you come in here, it shows you the non-commercial side, which is known as the large specs, and you have the commercial side, which are known as the non-speculators. Okay. And it shows you the amount of long positions they have and the amount of short positions that they have. So if I wanted to look up the euro, I'm just going to type in EUR and it's going to pull up the euro right here. And right now you can see that the big banks have a very large position on the euro, and they have a short position. Everybody has longs and shorts, right? But it seems like the bias is certainly to buy more euros than it is to sell euros right now. And then on the commercial side of things, you can also see these two markets. You've got the 565,000 contracts short and 388,000 contracts long. So this is actually something that I want to make sure that we talk about right now. So this is the most common report and is the short format of the CME. And you have, like I said, the non-commercial side, and then you have the commercial side. So I want to break these two down because whether you're a new trader to the COT report or an advanced trader to the COT report, it's really, really, really important that we break down the two sides. Okay, so non-commercials is a participant. And so when somebody goes to the CFTC and says, hey, we have this need to trade big contracts. Okay, we have a lot of money. We're a hedge fund and we'd like to trade. They have to self-declare as a non-commercial or a commercial. So there's an application you have to fill out if you want to be able to trade on the CME. Okay. So when they go out there and they say, okay, well, look, we're a multi-billion-dollar hedge fund. Our goal is to trade futures with the purpose of making money. And we have a few hedging interests as well, but we're basically just trying to use the futures market to create income for our clients. Okay. That's known as a non-commercial trader because they're known as large speculators as well. Large specs are people who they speculate on the futures market because they're just trying to make money. That's all they're trying to do. Now, if I'm a farmer and I live in the Midwest and I grow corn and I need to offset my crop and I have, thousands of acres, let's say it's a big corporation, I grow a lot of corn. Okay, I might apply to be a commercial trader on the CME. I might hire somebody to do this for me. The reason why is, let's say I have a bad year with my corn, I can offset my losses if I can hedge against like if I know I'm going to have a bad year, maybe I can go in and hedge through a futures contract. Okay. Those are commercial. That's an example of a commercial. Another example of a commercial trader would be somebody like a big multinational corporation like Walmart. You go out there and you have all of these stores that are all over the world, okay? And you operate business and you buy inventory from one country to another country, you transfer inventory from one country to another country, and you might be conducting business in a place where there's a lot of inflation going on. Maybe there's not a lot of inflation. Maybe the place you're buying from has a lot of inflation, but the place you're transferring those goods to doesn't have a lot of inflation or something like that. Those kinds of things, when you're dealing with lots of product and inventory, can really mess up your supply chain. It can really mess up your profitability, especially if it takes time to get inventory to one place to another. These guys act like Walmart has a Forex trading department. Um, Kind of crazy, right? Like that's a big deal. And so they go out there and hedge against their inventory and hedge against the currency holdings that they have in different countries. That's a commercial trader. Okay. So very important to understand that, because I think logically we look at these and we say commercial, that sounds like a professional, right? Which they are, but they're not the professionals that we're trying to follow. We're actually trying to follow the non-commercials because these are speculators who are in it to win it. That's all they're there for. They're not in it to use it as a hedging product or anything like that. It's just so that they can make more money for them and their clients. That's it. That's a non-commercial trader. Okay. Now, with that in mind, another thing that's really important to understand, whether you're new to the COT report or a veteran with the COT report, it's very important to understand. And this is where I feel like we have an edge because not a lot of people talk about this. I'm kind of one of the only, I actually talked to a CTA actually I talked to a CTA that actually manages a multi-billion-dollar portfolio, who's literally registered as a non-commercial with the CFTC. So on the phone with this guy, and he was saying, well, it's kind of a big deal if you think about it, that the commercial side of the market is one of the biggest, it's the biggest holdings, right? So when you look at how many positions are on the euro right now, who has more positions, the commercial side as an aggregate total or the non-commercial? Well, it's pretty obvious, right? Like even the long side of the commercial is bigger than, oh my gosh, it's bigger than the sum of the longs and shorts of the non-commercials. Okay. And then the short side of the commercials, of the commercial is bigger than the sum of the long and short of non-commercial and a little bit of the long side of the market for commercials. So it's really, really big. So there's a lot of people who trade with commercials. So here's the deal, guys. So when these guys make movements on a week-to-week basis, if they move the market, if they're buying and selling and moving positions around, often the market will move in the direction of what they're doing on a week-to-week basis. Okay, so these non-commercial, or these commercial traders rather, those farmers in the Midwest and the Walmarts of the world, they actually move the market um unknowingly necessarily. Maybe they're not trying to move the market necessarily. I don't think they're trying to necessarily, but when they make those movements, it causes this big ripple effect typically in the following weeks to come. And so that's where the COT shift data comes into play. Okay. So something to just to be aware of when we're trading the COT report, trading with the scanner, is that's where the shift data is coming from, is when commercials move, we want to pay attention to it on a week-to-week basis. Okay. Non-commercials, we want to pay attention to what they're doing on a longer term scale. And we're going to talk about that in just a moment.
Hey traders, it's Steve from the future. I hope you have enjoyed this video so far. If you are getting value out of this video, be sure to hit the like button, click the subscribe button, and share your trading thoughts. I read all the comments, so feel free to ask any questions you have there too. On a side note, I host live trading calls like this one you are watching every day. Some of my biggest trading secrets I share exclusively to just the members in my program. I host these live trading calls every day, Monday through Friday at 11 a.m. Eastern. I also host a basic training webinar every Monday for the newer traders, and the regular COT report and sentiment trading webinars every Wednesday night at 8 and 9 p.m. Eastern for the advanced and aspiring traders. All of these calls are recorded and promptly posted on the members' trading calendars at the conclusion of each call in case your schedule does not permit you to come to the live call. All of my members have complete access to the scanner. We call it Steve Scanner. This is an institutional grade trade alert scanner that picks the direction of the week on all 28 major currency pairs and includes trading instruments like gold, silver, NAS 100, US 30. Just in the last 90 days, I have made over 3,000 pips just taking the top trade signals from the scanner at the beginning of the week and then just holding those trade alerts until Friday. If you want access to the scanner, you can start a 14-day free trial with the join link in the description to get started. Lastly, if you really want to be a full-fledged VIP member of my program to get access to things like the basic training course, live signals channel, Steve Scanner, trading calendars, and the one-on-one calls with me throughout the month, you can use code Friend of Steve, that's Friend of Steve, no spaces, at checkout and save $50 on your first month. Again, just click the link in the description below and apply that coupon to become a VIP member, and I look forward to helping you with your inevitable trading success going forward. Now, back to the video.
So this is where I get the COT report data. Before we move away, actually, let's move away. Let's go to look at the journal. So I gather this data and I put it together. I formulate it in a lot of different ways. I do a lot of different, there's a lot of different derivatives and different ways of analyzing this COT data. But I like to, one of the things that I've been doing recently is I've been looking at, and this is something that got added into the COT report, scanner and to the scanner itself is looking at the crowded market concept, right? And so this is something I wanted to make sure that we're very clear on what we're doing. So naturally, like I was telling you guys, we want to follow non-commercials. So for example, right now there's a um, let's see, there's a let's see the yeah, on the US dollar, they're buying um right now the banks are buying dollars right now, okay? And they're selling, let's see, yeah, they're selling British pounds slightly. Or let's see, is there another one that's a little bit better? Um, that explains what I'm talking about a little bit better. Most of these are pretty biased. Yeah, let's just go with the pound dollar. So right now there's a little bit of a bias to short pounds and there's a bias to buy US dollars. So when you look at the pound dollar signal, um, the signal is to sell the pound dollar, and that's because pounds are going down because the big guys are looking to sell the pound, but they're looking to buy dollars. Okay. And so that's why there's been a sell signal issued on the pound dollars because that's the direction the banks are trying to go as of right now. So that's why there's a signal issued that direction. Okay. Let's look at, okay, the pound yen. That's a buy signal right now. Why is the pound yen a buy signal? Well, part of it's because the yen is so gosh darn sold off. Um, and let's see. Let's see. It's a sell. Yeah. So, oh no, it's a buy. Yeah. So that's right. So the pound yen's a buy signal because the yen's really sold off, but the pound itself is closer to 50-50. And what that means is the pound, even though it's slightly sold off, the yen is just sold off so much more that that's why the pound is stronger over the yen on a long-term basis. That's why we have a buy signal right there. So all of this is done for you in the scanner. It may not make a ton of sense, but all of this is already pre-calculated for you. You don't have to do a ton of analysis. I'm just showing you how this works. But there comes a point, and this is what I really wanted to highlight on. There comes a point when retail traders get, or not when retail traders, when the COT report data gets really biased. So when banks start to have a really big long position, then on one currency and a really big short position on another currency, they have no choice but to start to exit that position. So, one of the things that we've established recently that if you haven't come to these webinars recently, maybe you haven't heard this. If you have, you've probably heard this before. Is right now, one of the biggest positions out there is the euro against the franc. So, the euro is 72% long by the big banks. And then there's a franc position that's 85% short. That's a really big difference. Okay. So you've got really big long position versus extremely short position on the franc. And so in Forex, we trade in pairs. So when you pin the euro against the franc, the banks have been buying the euro for a long time and they've been selling the franc. So naturally, you'd imagine the euro franc to at least be attempting to go up. It's had its periods of moving up. I think from a much longer term scale, it's actually been going down. But these banks are going to have to exit this long position. So they've been going long for so long, and when they get really really long, they have no choice but to start to go the other way. So they actually have to exit. So we actually start to fade the non-commercials. So fading basically means you're going to go against what they're doing. So what they've been doing is buying the euro and selling the franc. So naturally we would want to sell the euro franc. And that's what we've been doing. We've been going out there and selling the euro franc. Okay. I hope that makes sense. Another good example of this is that the dollar's really long right now. It's 74% long, and the franc is super like I was telling you guys earlier, the franc is super short. So the banks for a long time have been buying the dollar franc. Let's actually pull up the dollar franc. This should move faster. I got my computer reset in between our break. So my charts are actually loading up. So look at this. So the dollar franc was actually going up for a long time. So from July all the way to October, the dollar franc was going up. So the banks were actually buying this for a long time, and they still have a long position. Now, at some point, like at the beginning of October, they get to such a big position that they have no choice but to start to exit. And that exit has been going on and it's not done yet. So we're actually still looking for sells on the dollar franc as this continues lower. We're looking for places where the dollar franc could continue to drop. Um, I think it's going to go another 100, 150 pips until you get to this demand zone down here on this higher time frame. And that's because the banks on the COT report data indicates that um, these banks have no choice but to get out of this position. They've been in this position and 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 anytime this goes up, they try to get out. In fact, I wonder if we're going to have a big move tonight. It's just Wednesday. It's Wednesday, so part of me wonders if this dollar franc's about to fall off a cliff. It might actually. I could see this do pull a last week. If you guys remember what happened last week with the um, this thing fell off, so did the euro franc. I kind of wonder if this is actually going to pull the same thing. Um, which is why I'm looking for sells. I have a couple of sells up here, as you guys know. I have some sells in here, but I wonder if we need to get a little bit more aggressive about selling this. Anyway, that's a side topic, but I'm just showing you this because that's what's going on here with the data is yes, the dollar, um, the non-commercials buying the dollar would send the dollar higher, and it has happened. And the franc being so short would send the franc lower, and that also has happened. But the thing is, now that they're so biased, they now have to exit. And when they exit, what that does is it causes this market to go down because they no longer can continue to keep buying because they bought everything up. So now they have to take profits and go the other way. And that's precisely what's happening right now. Oh, and Bill's here. Hey, congrats, Bill. Bill had as a grandson or granddaughter or new grandchild. So congrats. That's awesome. Um, all right, guys. So okay, so that's what we're doing. Um, new grandson. Yeah, that's awesome. I love that. Okay, so that's what we're doing with the long-term data. So basically, we want to follow this data. We want to follow non-commercials up until they get to a kind of I use the example of a rubber band. When they're expanding the rubber band, follow them. However, when they get to the point where that rubber band becomes so stretched out, don't follow them anymore. Okay, the scanner's already programmed to do this for you, but I just wanted to teach you that this is what we're doing. Okay, so like same thing. If you're playing an accordion, you stretch out the accordion as this accordion's going out, it's going out, it's going out. But once it goes to an extreme, and once it basically gets out to its, it can't go any further. Once that happens, you don't want to keep following the banks. You actually want to go against them. And it's a super powerful signal when you can actually trade against them. This is interesting logic because for a long time, and I used to trade this way for a long time. I used to teach people like, hey, let's just always follow the banks. But the thing is, there comes a point when even they have to be wrong too. And so the scanner is designed to kind of give you a little bit of intel to know when that's more likely to happen sooner. Um, we'll probably, I'm sure over the next several months, we'll continue to make this scanner even more agile and effective at picking that direction out even sooner. Um, but for now, it's doing a bang up job, and I've been very impressed and happy with how it's doing it. Um, and one of the reasons why I think it's been doing well is because it doesn't just look at the long-term signal. As you guys know, the scanner also looks at sentiment data, and it looks at the weekly shift data, and it gives an aggregate of all of those signals and tells you if it's more likely to go up or down for the week. And so far, these have been pretty darn accurate on the week. Um, Nothing's 100%, but yeah, it's been pretty darn accurate. Um, okay, so I think that covers this. So one of the things I've been doing, and let me know if you guys have other questions. For those of you that are kind of newer to the scanner, a couple of things you can do to interact with the scanner is you can filter this by the shift of the week. And again, usually the shift is probably your best indication as to the direction um, of the week. So if you're looking for a weekly direction, I think the shift is the bigger the shift, whether negative or positive, is more likely to tell you what's going to happen for the week. And that's been the case. I do think, if I recall, I think the pound dollar has been down this week. That's one of the top ones here. It's a 9.34 negative shift. Let's actually take a look at that. I think it's been down, hasn't it? Or am I wrong? Pound dollar. Oh yeah, this has been down for the week. Yeah. Let's pull up the um, weekly indicator. Yeah, wow. Geez, that's a great signal right there. Dang, that got you in right somewhere in that yellow area, and now it's here. What a great little signal from the scanner there from the weekly shift. Um, oh, nice. Okay, so you were down 331 pips, but almost up 600 pips currently. That's great. That's good news. Um, So yeah, the weekly shift is usually your best friend as far as figuring out the direction of the week. Um, and if you can combine that with other data, that's even better. So like, yeah, with this Aussie Kiwi sell, sentiment is a sell, and your weekly shift is a sell. So obviously the overall signal is as a sell here. You just don't have a long-term signal, unfortunately. That's the only downside to that, I'd say. Okay. Okay, I think that pretty well covers that. Okay, cool. Okay, so let me show you one of the things that I've been doing, guys. If you guys, unless you guys have other COT report questions, I wanted to show you one of the things that I do. I've been a little hesitant to share this because it's not something that I want you guys to do in your funded account right away. If you would like to try this in a demo, feel free to try it in a demo, but it is up to you. So there's a risk management strategy that I learned, oh man, like 6, 7 years ago, from actually one of my first mentors. And it works very effectively if you do it just right, though. And you have to have an edge in the first place. So you can't just do it on anything. You have to have an edge. So what I've been doing is for my swing trades with the scanner. So when I get a crowded market signal, and I know that for example, like if I'm looking at I don't know, the Euro CAD. Okay. And it's at crowded market stage. So I know that the banks need to get rid of their long positions and they're probably going to start going down. When I know that that is due, um, what I do is I'll go into the Euro CAD and let's pull up an hourly chart. And let's say I'm willing to build a position for several weeks. So here's what I do. I'll come in here and I got a signal to start selling this kind of early. I started getting a signal at the beginning, like I think it was November 7th is when I started getting a signal to sell the EuroCAD. And as you can see, that would have been early. Okay, so you're like 2 weeks early to the sell. Obviously, it did start to come down big time, mid-November, end of November here. This thing came down really big time. Now, if you had started selling right here at the beginning of November when you got that crowded market signal, for 2 weeks, you would have been like, this doesn't work, right? You would have been like, wow, this is definitely not working. He says sell, the scanner said sell on that long-term signal, and it has not come down yet. And by the way, I don't think it's done. I definitely think that if the crowded market signal came in over here and we're just to here, there's probably more downside momentum to the EuroCAD. So just so you know, that's probably coming. We're not done seeing the EuroCAD continue lower. So that's kind of my expectation. Anyway, let's come over here. So one of the things that I've been doing is this, and I'm trying to figure out the best way to show you. So let's say I take a sell right here when I first got this signal. Let's put a sell line right there, and I'm just going to put a market sell, um, a market sell, and we'll call this just a point 0.1 contract. Okay, we'll do 0.1. Let's just say I take a market sell, and this trade, we'll just say, and it doesn't have a stop loss. So this is my no stop loss swing trading system. But again, just please be aware that this is a like if you're going to do this, you do need this is an advanced technique of risk management. And if you're not prepared, you could get yourself into a heap of trouble. Okay. So I want to just show you how this works though. So just use it as an educational purpose right now. And if you want to attempt this, feel free to do it in a demo account until you feel like you've had enough practice and proficiency to do this. Okay, so basically, when I know that the banks have to go the other way, I'll go in and this again would not have a stop loss, but it would have just a market sell and you enter the trade. Now, what do you do next? Because what's the first thing that happens? Well, this market progresses throughout the first week and it actually goes against you. What this strategy says is instead of actually placing another sell like a lot of retail traders do, instead of doubling down your position, what you do, and actually let's do a rewind. Let's go back to here. Um, so what we do is, okay, the market is right here, and we know we got a signal to go ahead and sell this. So what we're going to do is um, place a sell stop just below this. And typically what I do is like a half an average daily range. I'll put an entry to sell, and I'll just do another sell, you know, 0.01 or 0.1. Okay. And this will be a half an average daily range below. And if it doesn't trigger, that's okay. But what you're doing is you're protecting yourself by not increasing the stakes unless the market is going in your favor. Because what the big mistake that a lot of retail traders do when they attempt a martingale system is, and I wrote off martingale for a long time. Okay. And I still do, just so you know, like I don't think it's a great system unless you can get it just right. And that's such a fine line to get it just right. So I only do if I ever use martingale, it'll be with a sell stop or a buy stop order. So just so you know, this let me just type this out. This is a sell stop. Um, and we'll say that this is half ADR half ADR. So we'll only get in if this market pulls back a half an ADR. Okay, so as this thing, and by the way, keep in mind this trade down here is still down. So we're losing on this trade down here, but we have another trade ready to go to break or to get us in after it breaks below this or a half an ADR below. And then we let the market continue to do its thing. Okay, it goes higher. So this sell stop never triggered. And then what we do is, okay, so we're still down on this one trade. It's that one trade is down a lot of pips, but it's not down a lot of dollars yet. Okay, then what we'll do is we'll bring this um, up. So you're not increasing the stakes at market, you're increasing the stakes as the market is willing to move in your favor because you know you're due for a move lower. You know that that's coming based off of the edge that we have. It just not has happened yet. So let's say we place a sell stop right there. We let the market progress. Okay, it actually did tick us in right there. So now we're in another one. So now you've got two trades now. This one is down a lot of pips down here. Not a lot of dollars. It's just a 0.1 contract, but you're still down on this trade. Then you have this one. You are down on this one right here. Then what I do is the next day or week, I'll come in and I'll place another sell stop. Okay, so I'll come in here. Unfortunately, that one just did not get us a very good price and we'll do the same thing again. I'm going to copy this and let's do a clone. Yeah, there we go. And we'll do another sell stop. So again, we're going to only increase the stakes if the market moves in our favor. We're not going to do it unless it actually does exactly what I just said. Okay, so now it goes on, it does its thing. It keeps going. It actually goes up a little bit further. Again, we're not in this one, so we'll come up here and we get it closer. We'll readjust it to a half an average daily range sell stop. Okay. We're still due for that move. Obviously, we're not super happy because we've got one trade that is down. We got a second trade that's down, but it's not like you've added, 10 different trades along the way up. It's been very much as the market's giving you moved in your favor and as it's moved along. Okay, so now we continue on. Let's see if this, okay, so now we get triggered into this sell stop. So here we go. Now we're in this sell stop. Now we're in 3 trades, and you can actually place another one later on. You can set your sequence or your frequency. You can decide to set up new sell stops every week, every day, but just make sure that it does not go over a certain amount. You just have to decide what those parameters are. So now you got 2 trades up here, and then 1 trade that's down here. So now we continue on. And again, it's up to you if you want to add more, but now you've got these trades going in your favor. And again, you're only adding if the market moves in your favor. That's the whole point behind the sell stop. Okay, so now you guys already know what happens. So again, maybe you've added more to this as this has come in your favor, but at this point, we just let this thing progress. It finally comes down, as you guys know. Here we are today. And it looks like it may even have more to go. I don't think we're done yet. So the whole point of this is you have an edge. It's a swing trading style. What you're doing is you're saying, I'm only going to scale in if it moves in my favor. And it has to be a small amount, like your lot size has to be pretty dang small. Now, with this trade, this is actually a decent trade if you think about it, because now you've got all 3 trades profitable, and it looks like there might even be more to the downside. Like we're probably not done yet. That's probably going to keep going lower. But for a tiny, we're actually down on this trade. But what's nice is you actually got 2 trades up here closer to where the market started to pull back finally. And that's where you have the bigger positions. So you're not adding on the way up, you're adding on the way back down. So if the market decides to continue up, you're not at, you still have your losing trade or a couple of trades that are down, but you're only adding if it starts to come back. See, this is the problem with most retail traders is they scale into a losing trade as it's going against them rather than holding the position and just saying, okay, I am down on this one unique trade, but when it starts to curve back in my favor, that's when the additions start to really happen. And that way you don't have to stop out necessarily out of a trade because maybe you didn't know that the market was going to go against you a couple hundred pips like it did here, but now it finally has. And so, the thing that would stink is to stop out of a trade when you know your analysis is correct, like it's a crowded market, it should go down like it is. So the nice thing about this technique is you have an edge. The edge is, okay, we're at crowded market needs to start coming down, right? And banks are going to start to sell off. And we're going to go ahead and go with them as the market starts to move in our favor. But we're not going to add unless that actually starts to happen, right? And on these 3 trades now, at one point, this trade would have been down. At your worst point, you would have been down about $300 on this trade down here at a 0.1 contract at your worst point. Okay, so that's your worst drawdown. So something to keep in mind if you're thinking about um, using this kind of model. Um, and then again, what you're doing is as this starts to come in your favor, you have a sequence and you can talk with me if you want to figure out how to do this. What I typically do on these swing trades is I will place sell stops that are a half an average daily range away. So if the market moves a half an average daily range in my favor, I'll get added into a new trade. Um, And then if the trade goes against me, obviously I'm just holding those, but I'm not adding to the position as it goes against me. I'm just holding what the portfolio that I have. And then when it starts to come back, that's when I start to add in my favor. So Bill, so I don't know if you heard earlier, but it's not this is a technique it is a martingale technique. I haven't really taught this because I use it for my swing style. It's not like an income producing, I mean, it produces income for me, but it's not like something that I teach in signals, just because, and I actually did this a couple years ago. I actually took a trade like this, but um, I decided not to send out signals using this anymore. And the reason why was because we had too many new traders that got burnt so badly. Um, they just got pretty burnt from taking they didn't do what I was teaching. They just kept adding to the position rather than waiting for the market to come to them, right? So the whole point behind this is yes, it is a martingale, but it's a type of martingale, and I've actually made quite a bit of money doing this on my swing trades, both in the stock market and in Forex. But the key to make this work is you have to wait for the market to come to you. That is the key. That's just the big thing right there. If you get the temptation to add a trade just because you think that might be the top, that's not going to work. You can't do that. That's how you're going to blow up your account. So you're only adding as it progresses in your favor. So what I was doing is I would typically do like a sell stop at a fixed contract, and you can keep it small. If you have a really small account, you can just do 0.01, just the smallest contract. In a $10,000 account, you could probably do like a 0.1. That's what I've been doing for every $10,000, just a 0.1. And then as this goes up, you're not adding. You're only adding if it comes down from its highs. And but it can't just be on anything. You have to pick something where you know that there's a pretty good chance that over the next couple of weeks or even the next month that you're going to get your move that you're looking for. So it is very much a swing opportunity, but it has the potential to provide a large paycheck for you, right? So again, this is something that I started at the beginning of November, and I was down on this initially. It went up against me, but I wasn't adding on the way up. I started the additions really big time when it started to come down, like right here. And especially, I made big time last week when this really started to fall off a cliff right here. So I'm sitting really, really good on a couple of my accounts now that this is finally falling off. But again, this only works safely and there's still some risk to it, definitely, but you limit the risk that you're actually taking if you add only on the way back in your favor. Okay, so I can't stress that enough, how important that is. Okay, so let's put it this way. So at one point I was down $300 on this trade, and then I was down on this example like 150. Let me move this out of the way. I was down about $150 on this trade. So you're down like $450 at the worst point of this trade over like a 2 week period. You'd be down $450. But then as this thing pulls back in your favor, you get tripped into this guy right here. As you get tripped into this one, that one now is profitable. And then this one is already tripped into, and now you've got these two trades. And then when these come down at this moment, you'd be up $350 on that trade. And then you'd be up another $250 on this trade. And then on the first trade you ever took, that's your least profitable trade, but you would be up another $77 on that trade. So like in total, that's like a seven, eight, $900 profit from this opportunity right here. Okay. And again, it's like there was no stop loss involved. What was involved was a knowledge, an edge that the banks were exiting. Once you got that signal that the banks were exiting, now is the time to go ahead and start to build that position. But When I say build, you're building it in as it goes in your favor. Because if the banks are not done and it continues to go against you, you don't want to add. Again, do not add as it goes against you. Add when it starts to come in your favor. That's the key to making this work very successfully. Okay. Also, Bill says, so I'm guessing no stop loss on trades, so no good for, yeah, this would probably not be a great strategy for a prop firm unless your lot size was extremely small. Um, so I've actually done this on prop firms. I have, but I haven't made a lot of money on prop firms. So because I've had a few drawdowns that have gotten up into the 10, 20% range on a few of these. Um, like I like to call these my, I don't know, they're kind of like I look for trade setups that could last a month. Okay. And honestly, if you could do like 12 of these a year, like one a month, type of thing, that's not bad. Um, and you could actually make quite a bit of money just working these, but you have to be very skillful about, you have to kind of have an idea already in advance about how many pips this could probably go. So when I first got this signal, this went against us a total of 340 pips before it finally collapsed and into our favor over the last couple of weeks. So the last 2 weeks have been all profits, but the first 2 weeks were like your first 2 weeks you're building this position and managing it, and then the last 2 weeks have just been bliss as the market's been flipping in our favor. This is kind of an extreme example. Most of these don't usually go against me this much, but I did do this one and I just wanted to show you that these can actually go against you kind of quite a bit for a little bit, and it can feel very frustrating if you don't have a game plan. If you have a game plan, it works really well. But here's the key. Okay, so now that you guys understand this, so you know that you add when it goes in your favor. But here's the thing: when are you most likely to add most of your trades with this model? Okay, this is the difference between, this is the secret sauce and why this works and why my mentor was so smart when he taught me this. um because this is the difference behind like why most retail traders die and get margin calls with their version of martingale. So I was telling you guys that in the sentiment webinar, when traders add to losing trades, they typically just take at market, okay, it goes against me again at market, and they're just, it's so painful, man. It's just so painful. You're just adding to a loser on the way up. So with this, here's the secret sauce: when this thing starts to go in your favor, you're likely to have your biggest position near the top. That's the key. So right up here, as this thing starts to crack, so this thing started cracking. We talked about this crack last week. I don't know if you guys remember in some of those webinars. We drew this trend line out on the EuroCAD. So this thing started to crack open. So naturally, most of my positions started to fill in up in here, up in this area, because this market was cracking. And again, we only start to add to the position as it starts to move in your favor. So if it's not moving in your favor, you're really not getting into a big position in the first place. So as this thing was going up, yes, I was down on this original trade, but I really wasn't adding a lot of positions. I did get into one or two right in here. I did get into one or two right in here. And then naturally, when this last peak came along, I got into many trades on the way down, and that's where most of this money was made, was on the way down when this market started to crack open right here after that trend line broke. That's when most of this money was, that's when I really got heavy into the position, is as it started to go into our favor. Okay. Um, so that's the secret sauce, because when a lot of people use martingale, they use martingale incorrectly, in my opinion, because they add to things when the going's bad. We only add to things when the going is good, right? So you're still holding a bad trade, right? From the beginning, sure. But when this market starts to go in the direction of your edge, of the overall direction that you had planned for in the beginning, when that fulfillment takes place, that's when the real positions, so you actually become profitable very, very quickly when this market starts to crack in your favor. And that's when your big position becomes, well, that's when your position actually finally becomes a big position, not on the way up. It finally becomes big on the way down. And that's the difference between how retail traders will do this and how we do this, right? So anyway, I wanted to show, so you can do this in stocks, you can do this in futures, commodities, you can do this in Forex. It's a great technique, but you do have to set limits, very hard limits on this. You have to say, I'm going to take a maximum of this many trades, and you have to set, you have to set up limits for yourself, right? I think I was prepared for this trade to go against me like 600 pips. It only went against me 350 pips. And then, obviously it started to go in our favor. And then, like I said, it's not like I had a lot of positions on the way up. I had most of my positions as we started to come down. So for me, I actually added, even on this, when this started to come down, I kept adding on the way down, right? So I'm just showing you this for illustration purposes, but I actually continued to build into this position on the way down. Okay, so you kind of know beforehand that that's what you're going to do in the first place. Um, and so as it goes up against you, you're really not doing anything, but as it goes in your favor, yeah, you're really getting into it big time. So that is my, like, one of the only ways I use martingale, but I just wanted to share that with you guys if that's something that you're interested in. Now, this is kind of exciting because I think a lot of you could actually make quite a bit of money in 2024 using this technique. But at the same time, I would definitely would want you to use it. Um, I would want you to use this on a demo for a while first, just to maybe do one or two of these type of moves. If you're going to do it on a swing trade, it's going to take you a couple more months because there's only a few opportunities you can get into in so many months. But if you're going to do it on like um, I mean, you could do this on like I'm trying to think of you could use this for a day trade. You just have to have a pretty good idea of where the market's going to go. I mean, you could maybe use it for like a shift trade for the week or something like that. Or if you had an overall signal from the scanner, you could do this same thing. So for example, with let's look at like the Euro Kiwi, that one's been a sell signal this week, right? You could look up this one and let's see, where did the week start? Um, Let me pull up this. Where did the week start here? Right here. So with this one, maybe this is not the best example, but with this one, you could sell originally at the start of the week, like we did here, and you put in a sell. And this actually went up against us up until Monday or Tuesday. You're not adding to it on the way up, but what you're doing is each night you're coming in and replacing sell stops, along the way down. So if the market does start to break into the favor or into the direction of the overall signal, then you start adding to the position on the way down, but it's never on the way against you. Again, this is different logic because most traders, they will add to it as it goes against them, but how many traders will actually do it the opposite way and add to it on the way in your direction? That's one way of doing it. I don't usually do it this way, as far as like on an hourly chart or on a weekly basis. I feel like what I've just taught you works really, really well if you're going to use it um, for a swing trade. Okay. Um, it also doesn't seem as I have a lot more patience for a swing trade with a small contract if I don't have a time limit on it, right? If you're trying to take a week to week trade and you're doing a martingale, you're going to be frustrated because the problem is that you have this idea in your mind that by Friday I'm going to be out. But with a lot of these other trades that I do, these swing trades, they last multiple weeks at a time. And like this one I did with EuroCAD took a month, 2 weeks of not really going in my favor. But then by the second week, the market started to crack in my favor on the EuroCAD. And then that's when the positions really started to get added in as the market started to come in our favor. And then by this week, Merry Christmas, right? Like that's kind of the idea with this kind of style. But you have to have an edge in the first place, and that's where the crowded market comes into play. So anything with a 5 out of 5 stars would probably do very well over like the next month or two. So like you could pick the Euro Kiwi, do a sell on that. That would be fine. Euro Yen, you could do USD CAD sell, Euro Franc sell, USD Franc. All of those are in crowded market stage. So my guess is if you were to do that exact thing I just taught you, you could do that. So one of the things I'm doing right now on the Euro Franc, because this is still one of the top trades to take, um, even though it's possible this Euro Franc goes up, let me give you another, and we'll wrap up on this. Let's say I take a really unfortunate trade. Let's say I sell the Euro Franc right here. Okay. I sell right there and the Euro Franc um, goes like, let's say tonight it just goes boom, right? I hope not. That's not what I'm positioned for, but let's say it does. Okay. Um, and I don't have a stop. Let's say I don't have a stop loss on this trade. Okay. So what we do is this thing goes up. Now, if you don't have a stop loss, it's because you have a really small contract. If you have a big contract, you have to have a stop loss. That is the thing, though. Um, and technically, you still need to have like a mental place, like, hey, if this goes against me, if I do a point 0.1 contract, and I'm willing to risk $300, then you could stop out at $300 and say, okay, I'll put a 300 pip stop loss or something on this. But just kind of have a mental idea of where you would stop out if you had to do that. I haven't really had to do that a lot because I've already been so small with my original contract is usually small enough that it's not a big deal. But let's say this thing's unfortunate goes against us. We're not, again, don't add to it on the way up like most retail traders do. Don't do this, okay? Don't add to it up here. What I want you to do is, have your sell stops ready to go. So if this thing decides to, go up a little bit more, put your sell stop, half an ADR ready to go for, one night of the week. And then if this market pulls back, trips you in, fantastic. If it happens to go up again, stay in both trades, place another, sell stop ready to go, half an ADR. And if this market finally cracks, now you've got, and then we'll add another one right here as it starts to crack. Now you'll make your money a lot faster and you'll recoup this bad trade down here very quickly because you're only adding when it comes in your favor. You're not adding when it goes against you. So you're not catching the knife. Okay. Have you ever heard the term catching a falling knife? So it's the same thing. Like if you're buying the Euro Franc, don't try to buy it on the way down. Buy it if it starts to come in your favor. Okay. And that's exactly what we're doing here is we're saying the opposite though. We're trying to sell it. So if this thing does spike up, instead of freaking out and being like, oh, this is going against me, here's a risk management technique that will actually help you get out. But it has to be very thought through. Like you can't just add the inclination is to want to solve the problem, right? So how do we often solve the problem or quote unquote solve the problem? We like to add to it on the way up, but the secret is to not do that. The secret is add to it as it starts to come in your favor, only if it comes in your favor. And then you'll watch how quickly you'll solve the issue when it starts to come in your favor. It can happen very, very quickly. You actually don't need a very big move to the downside to recover this trade from down here that was very unfortunate if you do it this way. But imagine if you have 4 or 5 trades up here that now finally come in your favor. Um, I mean, the profits can actually be very big. But it's only after you get that confirmation and that move in your favor. But it all starts with having a good edge in the first place, and that's what the crowded market's for. And then lastly, only adding when it goes in your favor. And then, of course, using a small lot size to begin with. Okay, so let's look at some of these. So you use a weekly time frame for these types of trades and just watch for different time frames. No, these are good questions. So no, kind of, yeah. So basically, we're using I usually go on an hourly chart or 4 hour time frame, but really the whole point is to use the crowded market indicator as a point of reference to tell you which trades are likely to move, like the banks are likely to create a move in your favor at some point. So like, for example, with Euro franc, we know it's a strong sell, and it's probably going to continue to be a strong sell for a little while. So even if the Euro franc goes against us for, let's say, a week, let's say the Euro franc goes against us, it just has a juggernaut rally to the upside. Let's say I have a sell or two in there. That kind of stinks. But at the same time, there's a way out of that if and when the market starts to move in the favor of the banks that they're trying to take it to. So when it starts to come down again, that's when you have those sell stops deployed and ready to go, only if the market moves in your favor. But it's never adding on the way up. That's how you lose and blow accounts. So we don't do that. We just work it as it comes back in your favor. Okay. Um, and then sell stop at half ADR below the current price each night. Yeah, that's what I've been doing. So a lot of nights if the market goes against you, you won't even get any new trades added because you're not going to add to it if it goes against you. So the next night you'll just maybe move your sell stop up a little bit because you're only adding if it goes in your favor. Yep, what goes up must come down. That's the idea, but again, it has to be with an edge. So this is my edge. My edge is, hey, the banks have to exit. And so I know that they have to do this over the next month or so. And so I'm going to build this position, but it has to be built when upon they make their move, not when I want to make the move. It's only when they make their move, I make the move type of thing. So, yep. So if it continues to go up, like you said, Lee, you're not adding, you're just readjusting that sell stop until it finally cracks in your favor. Once it cracks in your favor, that's when you start to scale in. Exactly. Yep. I'm down to take some trades like this with you guys, but you have to promise to do it in a demo account first. Okay. Okay. If you want to do it, I'm down to do it. I'd love for you to learn how to do this. This is actually a great way to make do some swing trades that can really put some money in your account. They really do work. You just have to be patient and do it right. So, all right, guys. It's been a great evening. Thanks for hanging out with me for so long. I love these evening classes. I really like hanging out with you guys. So thank you for coming. Have a fantastic rest of your evening, and we'll see you guys in the next webinar. Thanks for coming.